What's up, guys? We have an amazing episode today with Nancy Tengler. She is the Chief Executive and Chief Investment Officer of Laffer Tengler Investments, and she's been a top 1% portfolio manager for the last decade. She spent 40 years on Wall Street, and in today's conversation, she shared her 6 highest conviction stock picks for 2026. This episode is full of alpha. You definitely do not want to skip it. I hope you enjoy this conversation. Nancy, you've been super optimistic all year. You've been bullish when everyone was selling. You were bullish during DeepSeek, during tariffs. Can you walk us through some of the rationale behind why you've been optimistic on stocks all year?
Yeah. Well, so Phil, I've been drawing an analogy for 3 or maybe 4 years to the 1990s when I was a younger portfolio manager. And there are a lot of similarities, but I don't want to get caught up in the whole bubble talk because I don't believe we're in a bubble. But at that time, you had more sort of moribund growth as we were going into the 90s. There was a recession and you had interest rates at a pretty high rate. So the Fed funds rate averaged 5% all year. Inflation averaged all decade. Inflation averaged 3% all decade. And you had an environment that was where there was a tremendous amount of CapEx spending, but there wasn't necessarily a lot of growth. And so the question was, how did stocks appreciate then and why? And why was GDP growth? I mean, we went into the decade, I think we were at 1 or 2%. And GDP growth accelerated due to productivity. And this felt a lot like that to me. And so we started looking at the historical, comparable periods. And the 90s, I know some people have equated the current environment to the 70s, some back to the 20s, but it felt a lot like the 90s to me. And so what we learned from that is that you could see companies like Microsoft, which was simply a software company that worked on PCs, grow into something much more powerful. And so we began to look at the names that we really wanted to own for the next 3 to 5 years. And we used the volatility and weakness as an opportunity to add to holdings.
So I know something you've been pointing to a lot these days is the strength of earnings. Mm-hmm. And that's one of the reasons why you don't think it's a bubble. Can you walk us through that a bit more?
Yeah. So if you look at what's driving growth, it's certainly the AI trade, and the hyperscalers are 38% of the S&P 500, but they're still generating 20% growth. In the 90s, the leaders from a performance standpoint were the companies with decelerating earnings. So it was a single technology. It was the internet, eyeballs on a screen. And now what you have are very complex, robust companies with fortress balance sheets for the most part that are driving the earnings growth. That's one side of the equation, the picks and shovels, if you will. The other side is the old economy companies that are pivoting to the new technologies. So because our team listens to every earnings call across sectors, and we divided up economic cross sections, so you get retail and tech or utilities and consumer discretionary. So you get a broad view of the economy and you don't get just super hyper focused on one area. What we're hearing is not just that AI is improving margins, but that it's improving the customer experience and product development and, time to market and time to consumer and fraud detection in financials and, Goldman's using AI to write circulars and so offering circulars. So there's a lot of usages that are real, despite the fact that what you will hear people say on the financial news media is nobody's making any money on AI. And that's just not true. And our poster child for that for the last 3 years has been Walmart, which has pivoted to all the technologies. You go into a Walmart store, robots cleaning the floors, robots stocking the shelves. They use digitization in their consumer, in the e-commerce business. They're using AI for the supply chain. I mean, this is a company that's embraced everything. And it's shown up in their performance, their margins, and the dividend growth, frankly, which is a proxy for earnings growth.
Yeah, I think that's right. And I agree with you. Something that critics will push back on, though, is that, look, the AI adoption narrative isn't as pervasive as we might think because it's just some large language models, ChatGPT, things like that. That's what I hear a lot. People that do think maybe we should be a little more skeptical of this. But it sounds like you are seeing in your research and your work, you're seeing a lot more adoption than just some researchers using ChatGPT.
Absolutely. And also remember, like, I think, Wall Street analysts have models and they put stuff in models and they follow one industry. And I'm not being critical because we use their data for factual content. We don't usually buy and sell based on their upgrades and downgrades. But if you look back, like the poster child then for overvaluation was Cisco. And it was trading at 100, 120, depending on whose numbers you're using, times earnings. And it was trailing earnings. Peak earnings, by the way. I don't think we're at peak earnings, at least if the companies are halfway right about what the guidance they're giving. But John Chambers, who was the CEO, came out and said about a year ago that this technology, and he was just talking about AI, is more powerful than cloud computing and the internet combined. If you factor into that we will be experiencing quantum computing in the not too distant future, and robotics is really enhancing. Like we have a little podcast that no one watches, and we did one on automation, and there are robots that lay floor tile. There are robots that do roofing. You know about the Deere tractors that drive themselves and can pinpoint, weed, treating weeds. I forget what you call that, where you kill them and you don't kill the crops. Gosh, sorry, long day. Even though it's morning, and you can look across all the use cases and they're accelerating at a great speed. So if I'm looking at my life, I don't care if my kids take the keys away because I'll have Optimus, get me ready to go out, and then I'll hop in a cyber cab. So the world is changing and it's changing quickly. And there are the productivity enhancements that we're going to see out of that. Like if I don't have to fold my laundry, but Optimus does, that's pretty cool. Or if I need help in shaking a martini, I mean, that's not commerce, but there are commerce usages, and you'll start to see it, I think, you're seeing it at Walmart. I mean, 50% of order fulfillment is robotic, automated. That's pretty big for an old economy company. I think Amazon's probably more than that at the moment, but that kind of thing, it really enhances the productivity of the existing workers and the company.
I think these are a lot of things people don't know about. People talk about AI and they see OpenAI's products, they see Gemini, and they're like, okay, but what does that really do for the real economy? Most people don't know about the robots in warehouses.
Yeah.
I would assume. What do you make of the questions of circular financing in the AI economy?
Yeah. They think of it as a glorified Google search is what you're really saying. And
yes.
AI. Yeah. So I'm not as concerned about that as some people are, but I am concerned that OpenAI has overextended. I just don't have a lot of confidence in Sam Altman as an operator. I don't think he has the experience. That'll be super controversial, I know, but that troubles me that they're at the kind of the center of this. I would feel much more comfortable if it was, a Sundar Pichai or an Elon Musk who have experiences running businesses that have equal vision or better vision than I think he may have. And so that is a concern. We're watching that, but just think about what both Sundar and Elon have said recently about building data centers in space. I mean, there's no power problem in space. So there will be innovations that will solve what a lot of the naysayers, it may be bumpy. It usually always is when you have transformative economies or transformative technologies. And we are in a transformative economy where we're moving from hard labor in many cases to robots, to AI solving problems that entry-level people used to solve.
Do you get worried about how, let's say, a boom in AI productivity or a rise in robotics in everyday life, how that might impact the employment picture?
So I think if you go back to history, we used to, one of our 12 factors, and that's our research approach, used to be the buggy whip factor, which was obsolescence. When, the economy at the turn of the last century went from buggy whips to cars, buggies to cars, people that made buggy whips went out of business. That's the old school analogy. So we usually have found a way to really solve those problems as a society. I would hope to see from this administration retraining programs. I mean, if we're going to spend money on stuff, That seems like a really good thing to spend money on to me. A society that takes people who have been trained in one regard and moves them. But what's also interesting is I talk to a lot of people, our clients in particular, and many, more than a dozen in the last just couple of months have told me their kids have gone from wanting to be software coders to something else because they don't think that job's going to exist in the future, at least to the great extent that it is now. So people also adapt. And I think we will see that. This is a very adaptable country with a lot of incentives to do so. So I'm not worried. I know Elon Musk has said none of us are going to work and we're going to be on basic universal income. Okay. I don't see that. I think people like and need to work. We'll just find different ways to do it.
I agree with you. There's no universe where no one has jobs.
Right.
Because that's also how a lot of people find meaning, purpose. It feels good to get up and achieve something. Nancy, I want to pivot to your 6 stocks you've picked for 2026. And I want to go through each one and hear the thesis for each stock. So the first one, which you already mentioned, is Walmart.
Yeah.
Walk us through why you like this for the new year.
Yeah, because, Walmart is now listing on the NASDAQ, or they're moving to a listing. And so that's management's communication of what we've been talking about for the last 3 years. And they've been doing, I'm not taking credit for it. They've been implementing these technological changes. They want to be seen as a technology company that happens to be in retail. So if you think about how you scale that is how you scale retail. And one of the third or fourth derivative companies that we own in our thematic portfolio is a company called Symbotic. They are behind all the automation that has driven Walmart's growth, and particularly the logistics side of things. You know who their first customer was? It was Target. And Target did not avail themselves of the software. They decided not to utilize it. And the difference between the performance in those two stocks, and I think the future of those two companies, is tied to the fact that Walmart got ahead, and I don't know that Target can ever catch up. So it's a deep value play, if you ask me. And sometimes deep value is a trap.
Deep value, but also tech growth?
No, I'm talking about deep value for Target because they missed the opportunity. They didn't take advantage of automating their back office, their factories. Their delivery and logistics models. Yeah,
you have to lean into the new tech.
Yeah,
every era. It's a repeat pattern. So the next stock you've named is Advanced Micro Devices. What's the thesis? So
if you think about, one of the really important things for us is management. And that, by the way, is always something we watch when there's a management change. So we like the handoff from Macmillan. But in the case of AMD, Lisa Su took over in 2014, I believe. And the company had zero market share in CPUs, and they now have 41%. When I was a young portfolio manager, and I mean really young, we used to laugh that whoever they is, kept AMD around. It had like 1 or 2% market share in processors for personal computers, just so that Intel wouldn't be monopoly. And now what you're seeing is the flip side. Intel's yesterday's news, the government had to step in, and they may recover, they may not, but AMD has said at the recent investor day that they're going to grow the data center business at 80% for the next 3 to 5 years. That, I don't think Lisa Su is a charlatan, or as I was asked earlier, are there theater AI companies where they just say we're using AI and there's no proof of it? That is not her. They have a plan. They're focused on inferencing, and that is where AI is shifting to, away from just training to inferencing. So I think this company, it's down 20% in the most recent correction, or a little bit more than that. I think this is an opportunity to get in. We bought some earlier this year. We couldn't buy enough. We made our initial investment and it took off. This is an opportunity to step back in and say, I think I want to own more of this. So I think they're going to be a winner.
Some of you may not have heard this, but our partners at Public just launched something called Generated Assets. It brings AI into investing in a way I've honestly not seen before. Here's how it works. You type in an idea like AI-powered supply chain companies with positive free cash flow, or something like defense tech companies growing revenue over 25% year over year. Public's AI then dispatches a swarm of agents that can scan every single stock, evaluate them, and instantly build a custom index around your thesis. What really stands out is how clearly it explains why each stock is included. And before you invest, you can even backtest your idea against the S&P 500, so you're making decisions with real context and not just guessing. Beyond generated assets, Public lets you invest in stocks, bonds, options, crypto, all in one place. They'll even give you an uncapped 1% match when you transfer your investments over from another platform. If you want to build a portfolio that actually reflects your thesis, visit public.com/openingbell. That's public.com/openingbell. Now let's get back to the conversation. Okay, yeah, buying the dip on AMD, it's already up 80% this year, about 80%. Yeah. So even with the pullback, it's been quite a winner. Your third stock here is DR Horton. And this stock is up about 15% this year, about even with the market. Walk us through this one.
Yeah, so this is probably the riskiest of the group. And I think you have to do that as a PM and as an investor. You got to take some risk that may or may not work. And we can come back to that. But I think this is one of the best builders in the group because for our choices, because they are in the right market. So it's Southwest, Southeast, a little bit of Midwest, and they're in the right price point. So the first time buyer has been kept out of the market. The average sales price of a DR Horton home is $378,000. They've been able to maintain sales in this environment because they've been buying down mortgages for people. But I think if we get a housing recovery, this will be the first one to pop. It did earlier this year when we got the first rate cut in September, I think. It ran in anticipation of that. And then when the 10-year didn't budge, it came back in. But I think we will see something from this administration around maybe providing incentives to home builders because the problem is supply, not necessarily demand, especially for new homes. And then we'll see maybe some aid for the consumer. And don't forget, the lower end consumer and the middle end middle consumer are going to get a big boost in tax returns from the One Big Beautiful Bill Act because the tax rates remain the same from the IRS tables, but they actually went down retroactively. So you'll see about $150 billion in additional refunds for a total of about $512 billion. So first quarter should be good and second quarter for consumer discretionary, which is housing.
That is a fascinating thesis. I'm going to make note of that one. Does this have anything to do with the 50-year mortgage idea, or that's a totally...
No.
Okay, got it.
We get a lot of floaters out of this administration.
Totally. All right, your fourth stock here for 2026, Quanta Services. It's up 42% this year already.
It's in our 12 Best Ideas portfolio, which is a live, separately managed account that we manage for our clients. This portfolio is theoretical, right? Sure. We equally weight the names. But it's a company that's responsible for building the grid. That's their primary business. There's much hand-wringing over, will there be enough power for the data centers that are going up everywhere? They're also partnering with a lot of the data center builders. So they're in the sweet spot of the infrastructure. When we had the DeepSeek scare, which didn't scare us, but scared a lot of people, those stocks all got clobbered. GE Vernova, Quanta Services, Eaton. And this is a name, we just happen to like this one. They're all great companies, but we have a history with the company. There's an earnings history. There's a management team history. And so we thought that this was a good complement for the rest of the portfolio. I think they delivered a triple play this last quarter and raised, which means they beat, and raised. But they're also generating pretty strong earnings growth. Valuations in most of these names, except for DR Horton, are going to be pretty high. And probably the highest, one of the highest is Walmart. So remember, you got NVIDIA trading at 26 times and Walmart's trading at 39. So these are names that we're buying for the future, based on where we think the technologies are going or the themes are going. And that's why we like this name.
A lot of the bullish investors I've spoke with recently, they point to PE ratios as an old valuation metric that barely applies anymore. Do you fall into that camp?
No, I don't.
Okay.
But I will say this. So I think PE to growth probably matters a little bit more when you're buying growth companies that are accelerating. And so again, just using a poster child of low valuation, even though everyone says it's overvalued, NVIDIA is trading at a PE to growth of about 0.5 times. And Tesla's trading at 4 to 5 times. So valuation is important to take note of. But as a trained value manager, one of the things I learned in the 90s is that you can miss really important transitions in technology and the economy. I couldn't figure out Amazon for 20 years because it didn't have any earnings. How do I own this? There's no earnings. But if you go back, and my numbers are not correct, but you can check this out yourself on Grok, which is my preferred AI solution. If you go back to when the company went public, I think the stock is up. Last I looked, it was up 175,000%. So when was it too late to get in? Valuation's never been something you buy Amazon on. I mean, it didn't have a valuation for many years, nor did Tesla until they finally produced earnings. So I think sometimes as investors, we have to barbell our portfolios to consider where the world's going. And you're not gonna get a low PE on an Amazon, maybe ever. It's probably the lowest it's ever been right now.
Well, I like the idea of how can you try to price the future when you don't know what the future is?
Right.
And a lot of these potentially high growth companies, they're building things that they can't tell us about because they're going to blow our minds.
Yeah.
So how could we as investors try to put a metric on them?
That's where management matters, though, Phil. I mean, you have to have confidence in the management team. Like we sold Intel in the mid 50s because it was clear to me Pat Gelsinger wasn't going to be able to get it done. He got there, he looked around, he went to Washington, hat in hand, and said, "Could I have some money, please?" And meanwhile, they're getting further and further behind. So I think you have to think about that. I don't think Andy Jassy, using the Amazon example, is going to invest in the father of AWS and cloud computing is going to invest in CapEx that he doesn't think he's going to make a return on. I just don't believe that. I don't think I'm smarter than Satya Nadella of Microsoft. I think a lot of my peers in the business do think they're smarter. And a lot of Wall Street does.
Wow. This stock is very controversial, I would say. Tesla is one of your picks for 2026. A lot of people think this is way overvalued. They think the stock is supported by the cult of Elon.
It is.
It is.
Yeah.
I like Elon. I think Tesla's an amazing company. Walk us through the thesis here.
It's overvalued if you think it's an EV company, and we don't. We think it's one of the biggest AI companies, full self-driving, what drives robots, AI, what drives the future, all of the above. So when we got back into the stock, it was when Elon was selling shares. Nobody knew, but he was selling shares to buy X/Twitter. We picked it off because I had owned it early days when there were no earnings, and the guy is fraught. So he was sleeping on the factory floor, going on Phil Rosen, smoking pot, drinking with,
Joe Rogan, you mean?
What'd I say?
Phil Rosen.
I'm sorry, Phil Rosen. The Phil Rosen podcast.
Yeah.
Joe Rogan. Sorry. And I think we just made news, Phil.
We might have, yeah.
So anyway, I just couldn't justify it to my clients because there were no earnings. So when we had a chance to, and so we got a double out of it, and then it went up fivefold. That's harder to justify to your clients. So when we got a chance to get back in, we got in about $104 a share. And what really intrigued me, I went to one of the factory tours of the Megapack business, and that's the electric utility grade battery packs that store renewables. And that's a big business. It's a bigger business every quarter for Tesla. It was the fastest growing, most profitable. It still is. And that was kind of the bridge that got us to where we are now. So it's AI. It's XAI now because Tesla now is going to invest in XAI thanks to the shareholder vote. It's maybe the future is space, where he merges SpaceX, and but more importantly, it's full self-driving and robotics, and we think that is going to be enormous as a revenue and profitability and change the world factor.
Real quick, we'll get right back to the interview. Just wanted to pop in and say, if you like this content, I write a newsletter every single morning called Opening Bell Daily. I cover macro, the stock market, asset prices, why things are going up, why they're going down. And if you want to get that for free, you can sign up at the link in the description. Let's get back to the interview. To be clear, I'm very bullish on Tesla, and I think everything you say makes sense. One pushback I hear very often is that so much of the valuation right now and the stock price is built on whatever Elon is saying on earnings calls, which is, hey, this is going to be a $10 trillion company and no one's going to be able to keep up with us. Does any of that concern you that maybe he's like bidding it up too much?
I mean, let's not forget the SEC problem. That was also going on when I got out the last time on his tweet, said he had a buyer at whatever value. Have you read his biography? Because I think once...
Walter Isaacson?
Yeah.
Yes.
Once you read it, you kind of go, oh, I get it. It's a playbook like Art of the Deal. Do I like it? No, I don't like it. I mean, this is not someone that I would probably hang out with. But in terms of vision and execution, I don't think there's anyone in my generation that's better. And so the question becomes, is he early? Yeah, he's always early. Is he ultimately right? Pretty right. And I don't... I've been on some of the podcasts. I went to the We Robot. I was invited by Tesla to go to the We Robot. And I thought I was very special until I got there and there were thousands of retail investors. Everybody I met was a retail investor. There is a cult. Other companies use share buybacks to put a floor under their stock. The retail investor puts a floor under Tesla. And so many of them have made so much money that I don't think you're going to see nervous sellers in any periods. And that's how he got the pay package through. I mean, they worship at the altar of Elon. When he came out, it was like a rock concert. I was a little put off because, I thought, wait, what is this? It was a performance.
I mean, he is a rock star.
He is.
He acts like one.
Yeah.
All right. So your last stock of these 6 high conviction picks, CrowdStrike. It's up 48% this year. Walk us through this.
If you think about agentic AI growing, this is probably the best cybersecurity provider in that particular space. So they're platformizing their business like Palo Alto. They had that big problem with Delta. So the stock sold off. If you recall, the software went down and Delta was shut down. It was not that long ago, 6-9 months ago. The stock has come back. They're probably going to deliver a fourth quarter, third quarter, triple play. So a beat raise. And that's what we're going to be watching. But I think this is the company you want to own in cybersecurity. I will point out to you that Palo Alto's in our 12 best ideas portfolio, but we're actually reconsidering that. And that's why I put CrowdStrike in the 6 for 26. So we all need it, and it's going to be more and more important as AI takes on more importance, particularly for individuals.
I think that totally makes sense. So I want to press you a bit on these valuations. And I know we talked about the valuations, can't put a price on the future. A lot of investors will look at this list and say, okay, DR Horton is the only one that doesn't have a ridiculous PE. What do you say to that?
Well, I say you're probably not a growth investor. And that's okay. I've been a value investor my entire life, until probably the late 90s when I wrote a book called, I don't remember what it's called, New Era Value Investing. And it was on the notion of using relative price to sales ratio. Because before that, we had always used relative dividend yield. And I'll be very quick in explaining that, but it's the yield that on the stock relative to its own past and relative to the S&P. And in big old economy companies, management set the dividend based on what they think is a portion of long-term sustainable earnings power. And so it's a shortcut into earnings growth. And it's an effective one. Like using the Walmart example again, they were raising the dividend a penny a year for a decade or longer. And then suddenly they raised it 9% and then 11%. That told me that management was super confident in the future, from an earnings growth standpoint. So that's a value investor. A growth investor says, I'm buying the story, I'm buying the growth. And that's where valuations become more, less important, but certainly something we still pay attention to. Like I will never be the person that says PEs don't matter. They matter. It's just a question of how much do they matter to a growth investor and in what regard. It's an input for us. And we look at it. But as I said, with accelerating growth companies, we're more interested in price earnings to growth.
Wow, that's a great take. And I think it certainly makes sense. So you also manage an ETF. Can you walk us through sort of the strategy behind the allocations and give us the elevator pitch for investors? So
we use the valuation metric, the former that I outlined. So it's relative dividend yield. We want to buy companies with growing yields, growing dividends, and not high absolute yields. necessarily. And that's where I think most value investors get trapped. And that's why it's done so well. So if you look at our metrics, we're saying, okay, is it cheap compared to its own history? Yes. Now we go and do the research to find out if it's cheap for a good reason. And then our macro view is reflected. So we're market weight in that portfolio to just under market weight to technology, which is probably a lot higher than most other investors. But recently we added a name like IBM, which is a quantum play. I mean, we're a little bit late, but I think the story has a long way to go. We own names as diverse as Microsoft, Apple, and Lam Research, so lower yields. Google, we put in the portfolio 18 months ago when they started paying a dividend because we anticipated growth. It became one of the largest holdings in the Russell 1000 value. And so it's looking at names that way. Fallen angel growth stocks is how I would define it.
Okay. I think, and the ticker is TGLR, right?
Yeah.
Okay. Everyone should definitely go check this out. So I want to talk to you about a stock pick you gave me earlier this year.
Yeah.
We did an interview and I asked for your highest conviction stock that we published in our Best Ideas Club. And the stock pick was ServiceNow. As of this recording, it's negative on the year. It's down double digits.
Yeah.
What happened on that stock pick, and what are your thoughts on it today?
So when you ask an analyst for one pick, they have no problem because they rank them. But portfolio managers, we put stuff in the portfolio to do different things. ServiceNow has one of the best CEOs, and by the way, it's down 23.7% through Friday, or 23.4. So mea culpa. But it's a name we still like. So if you look at the company and what they're doing, they're really critical to AI cloud. So they're utilized by the government, by big corporations to really make the cloud more efficient in AI data flow. That's the best way I can explain it. The CEO is probably Bill McDermott is one of the best CEOs in the country, in my view. He is also part cheerleader, but he's a great operator, and they are still growing the business in the 20 to low 20% area, not just revenues, but earnings as well. And so they're shifting their model to subscriber model. That was part of the problem. The other problem was the market sort of fell out of favor with software companies because there's this narrative that AI is going to replace software. I don't think that's true. And it's particularly not true in the case of ServiceNow. We recently added to it in our growth portfolio it's also in our 12 best ideas portfolio. And then I would just point out one thing. Hopefully you had other ideas in the Best Ideas Club. The 5 for 25, which it was a member of, and that's why we talked about it, is up 27.7% this year, despite the fact that ServiceNow is down 23.7. So if I was keeping that portfolio, I would be adding to ServiceNow here because I do think they are part of the future and they will continue to grow. So hopefully the other names did what they were supposed to do. And then this name is one that you might want to think about adding to. So just to be clear, you haven't sold ServiceNow? No, we've been adding to it. Okay. Yeah. Wow. In our growth portfolio and in our 12 best, we recently added to it. Now, when you say sell, sell to me is we got out of it. Mm-hmm. Sometimes we trim, like we recently trimmed, in the summer before it got stinky, we trimmed some. But generally speaking, no, it's still a huge holding for us. Okay. This has been great. I learned a lot, and I think all these stock picks, all the theses behind them are fantastic. So, Nancy, I really appreciate you taking the time. I'm rooting for the Phil Rosen podcast going head to head with Joe Rogan. Thank you. One day.